I've got a lot of content this week, and beginning with an interview that Consuelo Mack does with economist Jim Grant. You may know of Jim Grant. He's well thought of, published a lot of books. But if you're not in the area of economics, you probably may not have heard of him. But she does an excellent interview, and what the focus that she's focusing on is gold. The price of gold, what's causing it to go up, and I would add gold and silver. And he gives a very good explanation of what's behind that, and so I'll go into that detail. Secondly, I'm going to cover are tariffs inflationary? I'm going to give you two views. One is done by CNBC, which is, yes, they are inflationary, and they make a case for that. The other is done by Jim Rickards. You may know of Jim Rickards, and he makes a case that they're not inflationary, so giving you kind of two opposing views. And finally, Professor Steve Henke from Johns Hopkins University, professor of applied economics, and he's going to go into what would cause the U.S. to have a slowdown in the economy. Is it interest rates, which is commonly held, or is it the increasing or decreasing of the money supply? And he contends the latter, so he goes through that. So a lot of good content. And hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is July 15, 2025. Okay, I'm going to begin with this interview that Consuelo Mack does with Jim Grant. She goes into an excellent introduction of him, so I won't add to that. I don't need to. And he tackles the question of why is gold going up in price? What drives that? It's a very good question. A lot of people ask it, and he gives a thoughtful answer. Gold tends to go up when there is a weakening confidence in the dollar or vice versa. And the reason it's the dollar is because we are the reserve currency. Again, he unpacks that idea. China has been buying, I've been following for 30 years, but I've been tracking really what's going on with the buying of gold by countries around the world for about 10 years. And during that period of time, China has been buying all of the gold it can get its hands on. I won't say it's exactly the majority, but it's a lot. And in my opinion, actually, in the opinion of Jim Rickards, the purpose of that is to more legitimize their currency, because their currency is not, it's got credibility problems. And so they're the number one buyer. Russia's number two, and India's number three. It's been that way for the 10 years I've been tracking it. They don't publish their numbers, so whatever they say, it's not generally viewed as credible. So I don't know how much they have. No one really knows, but they have a lot. And of course, India has a lot, and Russia has a lot. The U.S., interestingly enough, had about 14,000 metric tons of gold. And then the countries in Europe, we were buying a lot of things in Europe, and they were piling up dollars, which they didn't want. And so the deal we made at the Bretton Woods Accord in 1944 was that we would create an equivalency between gold and the dollar. So if, you can have the paper dollar or you can have gold, and it had that much credibility. And we were on the gold standard. So these countries, Netherlands, France, Germany in particular, they literally sent ships to the U.S. full of dollars. I'm going to say they're probably $100 bills or 20s or 50s, I don't know, but literal paper, sent them to the U.S. in exchange for gold. So they emptied, I'll say Fort Knox, because we have our gold is in 4 locations, but I'll just use that generically, just call it Fort Knox. They emptied that of about half of the goal. So we went from about 14,000 metric tons down to, or excuse me, I think it was 16,000, I stand corrected, down to 8,133 metric tons, if the numbers published are correct, and I know there's a question on that. That was in the early 1970s. So since that time, I can't find any documentation that shows that we the U.S., have added to our gold supply. So around 8,000 tons 50 years ago, and it's still 8,000 tons. Well, China is buying thousands of tons. India and Russia are buying as much as they can get, and they've been doing this for a long time. We are not. And so part of the problem with the devaluation of our currency, or you could call it the inflationary aspect of it, is that the dollar buys less and less and less. Look at what you could buy if you were around that you could buy in 1970 or 20 years ago, 30 years ago. Look at what you could buy versus what you can buy today. Why is that? More money in circulation, more printed money, but it's also backed by nothing. So if we'd been adding an equivalent amount of gold to that, you know, my opinion is I don't think it would have diminished as much. But that's, I can't solve that problem, but that's just an observation. The future, gold has been going up a lot, silver going up a lot. And the future looks very promising for both gold and silver. And you could add other precious metals like platinum and palladium to that as well. But most people focus on gold and silver. The geopolitical landscape is uncertain, and this leads to a weakening of the U.S. dollar. And of course, we're seeing the increase in the price of gold and silver. So I'm just going to stop talking and turn on Consuelo Mack and Jim Grant. I think you'll find this interesting.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. We are delighted to welcome back one of Wealth Track's earliest guests who has graced our program over the years with his perspective on all things financial, which he is well equipped to do. He is James Grant, financial thought leader, historian, founder and editor of Grant's Interest Rate Observer, a twice-monthly journal he launched in 1983, more than 40 years ago. As you will discover, he and it are going strong. Grant is also the author of 10 books on finance and financial history, including The Forgotten Depression, 1921, The Crash That Cured Itself, which won the Hayek Prize from the Manhattan Institute. He has also written 3 political biographies, one of my favorites being John Adams' Party of One, about the remarkable life of America's second president. And his latest, Friends Until the End, Edmund Burke and Charles Fox in the Age of Revolution, which I am looking forward to reading. Grant is also a contributor to several publications, including the Wall Street Journal and Financial Times. But today, he is with us to discuss a number of topics. I decided to start with gold, an asset he has owned for years, not always to his financial advantage, but that is not the case today. Gold has been a stellar performer. I asked him why.
The world has come to reappraise the nature of money a little bit, I think. And some of that reappraisal has to do with comparing the nature and value of paper currencies, including the almighty dollar, with that of the ancient monetary relic, gold bullion. And central banks especially are coming to favor the latter over the former, which is odd and ironic because the gold price is kind of the reciprocal of the world's confidence in the people who manage our currencies. The higher the confidence, the lower the gold price, the lower the confidence, the higher the gold price. That is a general rule of thumb. As we speak, the trend has, just as you say, has been up for a while, for a long time. And I think it speaks to a general reconsideration or reappraisal of the nature and the efficacy of the world's monetary arrangements.
Jim, this is right up your alley. I mean, this is something you have been writing about for 40 plus years at least. And I'm wondering about what your assessment as to why central banks especially are buying gold, rejecting their children paper money. What's happened that there is this reappraisal now and that they're actually acting on it?
It's a bit ironic, isn't it? It's the kind of the consummate insider buying. I think people are looking a little bit at the seeming arbitrariness of American actions with respect to using the dollar as a geopolitical weapon. You know, saying no, you may not use Fedwire or chips or fast and dollar transmission mechanisms because we don't agree with your politics, or we don't like your invading this country or that country. America has been known to wield the dollar as a tool of negotiation or of raw power. I think countries like to have a little bit of agency. And for that reason, they like at the margin, they're liking gold. Gold is moving up a little bit in the league tables of world reserve assets. It has surpassed, we are told, the euro. It's gaining on the dollar itself, which would be that most interesting development.
So gold as a share of foreign exchange reserves are 20% plus. The euro was 16% the last time I looked. Yeah, and you're saying that we're underestimating?
A lot of these reserve figures are educated guesses. For example, people must speculate with respect to, for example, the Chinese official holdings of gold bullion. The Chinese by no means acknowledge everything they have.
Jim, you are a financial historian. The recent, again, reappraisal of gold, and I'm assuming the reappraisal of the dollar as a result, coinciding with, or the reason that gold is becoming more popular. Has it been more marked recently?
Gold has been coming back in the past year or so with surprising power and lift, because why? What makes gold go up? Well, historically, Consuelo, the owner of the strongest currency, the reserve currency, was one with the strongest and biggest navy. And the United States no longer has title to that distinction in the Pacific. China, yeah,
has the largest.
So there might be some at the back of the minds of some of the buyers of gold, say in Asia. Asia's been the center of this buying. Maybe there's some recalibration of geopolitical strength. Again, one doesn't know. Actually, there's been very little, relatively speaking, very little buying here in America, and not so much in Europe. Although Europe is a big legacy holder of gold. France and Italy, and Germany especially, hold a lot of gold. And by the way, some of them, these countries, want to repatriate it, as if to say, America, you've been so nice to keep it for us, but we watch the news too, and we think we'd rather have it here.
There's a couple of things that I do or don't do. One is I try to stay away from political commentary, because you can get that just about anywhere or everywhere. So you don't need my comments on that. And the other is that I try to show both sides of issues, particularly controversial issues. And the issue around tariffs are tied to Trump, tied to the White House, and that makes it very political. So, but the question is, are tariffs inflationary? So depending on where you are politically, what I find is that people who are anti-Trump think that they are inflationary. And people who are pro-Trump think that probably they're not inflationary. We don't know. And so I found a piece that was tariffs are not inflationary, done by Jim Rickards, a very good piece. So then I went looking for some material that was on the other side, that the tariffs are inflationary. There's a lot of material out there. I chose one which is done by CNBC. It's kind of a special that they did, and I think it's as good as anything out there, but it makes the case of why tariffs are inflationary. So I'll begin with that one. and then I'll introduce the second one after this one. So take a listen to this piece done by CNBC.
The U.S. government is poised to shake up global trade in April 2025.
I call it Liberation Day. April 2nd is Liberation Day.
The White House has proposed several kinds of tariffs.
A tariff is a tax on goods as they pass the border. For each instance in which a tariff is put on, it would lead to a price level shift. That shift constitutes inflation.
Economists say the administration's tariff plans could be inflationary. Some are on specific industries, like pharmaceuticals and automakers. Others are on entire countries.
They sound very inflationary. It sounds like they're going to jack up prices. The history of tariffs suggests that they generally don't. However, we could be in a whole new ball game here.
Considering what has happened in the past few years, where we had quite some inflation in the US, it's going to be much more difficult this time to pass it through consumers.
That said, tariffs are not the sole cause for concern, according to the U.S. Central Bank, the Federal Reserve.
Trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy.
Are tariffs inflationary? Over the first half of the 2020s, the prices that Americans pay for items of all kinds rose at a fast pace. Higher tariff rates could make prices begin to climb again. This happens if businesses mark up their products.
A business markup is the difference between what a business spends and what it asks the consumer to pay. Because most producers and retailers charge a markup, it's really important to take into account how these markups respond to cost changes of imported components.
Businesses have the discretion to absorb those costs or pass them on to consumers.
You have to be aware that if you increase prices, consumers will consume less. We have been in this inflationary environment in the US for a longer period of time, so that the budget of consumer has gone down quite systematically for this kind of spending.
The White House rapidly proposed several tariff rate increases in the spring of 2025. This has led to confusion among a range of business leaders. The oil and gas industry, for example, is feeling pessimistic amid the uncertainty. Automakers have concerns too. Many parts within the vehicles cross borders under past global trade agreements. With tariffs in place, cars assembled in North America could cost $4,000 to $10,000 more.
Even though the American consumer is not necessarily buying this engine themselves, this is still going into the light truck that they are ultimately buying.
What we have seen, for example, is an increased inventory. A lot of cars were sent over the Atlantic and the Pacific pre-Trump, but it means also that you can have a slowdown then in production in these countries afterward.
Higher tariff rates on China, Mexico, and Canada alone could affect consumer prices.
That would add between 0.5 and 0.8 percentage points to core PCE inflation, depending on how you think markups will respond.
If tariffs reach the maximum levels suggested by Trump while campaigning for his second term, it could add up to 2.2 percentage points to core PCE inflation. In a statement to CNBC, a White House economic advisor said that tariffs from Trump's first term made no meaningful contributions to inflation. He added that foreign suppliers will have to eat the economic burden.
I think the odds are very high right now that we have not seen the last of the tariff proposals. He likes to use things as bargaining chips. And what he will do is start at the most extreme position and work his way in. The last thing Trump or any other president wants to do is to oversee a recession. If it is indicated that tariffs are going to cause a recession, he's certainly going to back down on that.
Okay, secondly, on this same topic of tariffs being inflationary, Daniela Camboni interviews Jim Rickards at a conference that they were attending in Miami, and very good interview, very relaxed setting there at the Boca Raton Resort, and I think they're out on the deck. They got their sunglasses on, and good. And he's extremely insightful. And I've only read one of his books, but he has many books out. But he takes a position that tariffs are not inflationary and tries to make the case for why that's true. So take a listen to Daniela Camboni and Jim Rickards.
I don't think I've had one expert come on, tell me the tariffs will work.
Right.
Can you make the argument that they will work?
I can make the argument, and I have 235 years of history on my side. So a couple points. What we're up against, there are a lot of narratives. Wall Street loves narratives. Commentators love narratives. Narratives just fancy word for story. They want a story. And stories are very powerful. People buy into them and they act accordingly. But a lot of narratives are false. They're completely wrong. So then what's the narrative today? The narrative today is, and this has been true for 50 years, free trade is good. Everybody wins from free trade. If the other guy puts on tariffs, too bad for him, but you still benefit from no tariffs. We get cheaper goods. Um, uh, Comparative advantage, going back to David Ricardo, I think he published his work in 1819 or thereabouts. Free trade is good and tariffs are bad. And as applied in the current context, tariffs are inflationary because they raise prices, et cetera. So that's what you hear from everyone from Larry Summers to talking heads on CNBC, et cetera. It's all wrong. Let me explain why. First of all, as far as tariffs being inflationary, it's just not true because everyone said, well, if you put tariffs on imported goods, they're going to raise the price to the consumer. No, there are three principal parties in the supply chain. It could be 20, but three conceptually. There's the exporter, let's say the Chinese manufacturer. There's the importer who receives the goods at the Port of Los Angeles or Port of Houston. And then there's the consumer who buys the goods. So you have these three people in the chain. Now, who writes the check? The importer, in my example, the Port of Los Angeles, you receive the goods. You got to write the check to the Treasury for the tariff. So you're the one paying it in the first instance. But who bears the economic cost? Because that can be pushed up or down the supply chain. I can tell you who's not going to pay it is the consumer. The consumer is tapped out. This came out on your panel yesterday. Consumers tapped out. Auto loans are going up. Mortgage equity is disappearing. Student loan debt is, you got to pay it instead of ignoring it. So that's going to be a weight on the consumer. Unemployment's going up, et cetera. There are a whole lot of kind of macro elements that go in there. But the bottom line is the consumer is not going to pay. If you put it on the consumer, they're just not going to buy your stuff, or they'll find something else that's cheaper, or substitute, or as I said, they'll find some other goods or just not buy it. So, and by the way, if Walmart and Costco and Target could raise prices, why wouldn't they? They don't need tariffs. It was the fact that they're not raising prices means they can't, tariffs or no tariffs. So now we're back to the importer and the exporter. And in reality, there's a lot of research that backs this up. They split it between them. Now, the importer can turn around to the exporter, the Chinese manufacturer, and say, hey, it's on you. You bear the cost of the tariffs. Lower your inputs, lower your costs, or reduce your profits, reduce your margins, do something. I wrote the check, but I'm not paying it. I want cheaper prices from you if I have to pay more. The point is, it's not inflationary because the consumer doesn't pay it. It is shared on some basis between the importer and the exporter. It could be lower profit margins. It could be lower stock prices, but it's not inflationary. In fact, quite the opposite. So that's number one. Number two, the U.S. did not have an income tax until 1913. How the heck did we pay for the War of 1812, the Civil War, the Mexican-American War, the Spanish-American War, invent the telephone, telegraph, railroads, transcontinental railroads, harvesters, industry, Henry Ford? How did we do all that with no income tax? The answer is tariffs. That's how we ran the country. That's how we paid for everything. So what Trump is doing, and just give you one more quick example. There's no such thing as free trade. People talk about it. They teach it in schools. I was a pretty good student in college, but I struggled a little bit in economics. And I was like, I got an A's and everything else. What's up with economics? But it took me.
That's news to me, by the way. But
Well,
okay.
it wasn't until really decades later that I realized that everything they was teaching me was wrong. Like everything I learned in economics was wrong, and so that's why it never quite made sense to me. I figured that out later. But this idea of free trade, it's based on the notion that England has woolens and textiles. Portugal has grapes and wine. Doesn't make sense to grow grapes in England. Why don't we trade textiles for wine and everybody's better off because we're all doing the thing that we do best? That's the theory of comparative advantage. It's nonsense. And Ricardo said this himself, and here's why. The inputs, the factors of production are mobile. So let's go back to 1975. What was Taiwan's comparative advantage in semiconductors? Zero, none. They had a comparative advantage in tuna fishing and rice farming, okay? But today, they're the largest, most powerful, most advanced semiconductor manufacturer in the world. How did they do that? They just did it. They made it a government policy. They put the government behind it. They attracted talent from California. They attracted capital from around the world. They had a very liberal policy. Like if you worked for Taiwan Semiconductor in the 80s or 90s and you wanted to start your own business, they would say, do it, and we'll give you seed capital. As they created a whole ecosystem. But my point is, they did it out of thin air. So comparative advantages is nonsense because you can create it and the factors are mobile. So the question is, if you want economic growth, what do you need to do to get that economic growth, get that investment, et cetera? It's not free trade, it's tariffs. Because what Trump has said, he said to the world, hey, you can sell anything you want to Americans, anything you want, free of tariffs, but make it in the United States. And that's really the point.
And finally, I want to introduce a piece, just a clip from Professor Steve Hinkie, the professor of applied economics at Johns Hopkins. And he takes the position that what impacts the economy is not interest rates. It is commonly believed that interest rates do. And he says both Chairman Powell and President Trump both are saying that they believe that they do affect the economy, interest rates affect the economy. And Powell has been holding down changes in interest rates. Trump wants to get them reduced. And he says basically neither one apply. Really, it's the money supply that affects the economy. So, and since he's who he is, I would defer to his judgment on that. And then he dismisses Powell's and Trump's positions. Okay, so take a listen to Professor Steve Hinkie.
So there is so much happening in the world, and we got a lot to discuss here, both from an economic point of view and also geopolitical point of view. And I want to touch on both with you, but I want to start with the economy first, okay? Seeing how money makes the world go around. And we recently had a Fed meeting, and I know you love talking about Jerome Powell, but before we talk about him, I want to read a quote that the president sent out a few days ago, and I want to get your thoughts on this quote, okay? Once again, it was on Twitter or Truth Social. Too Late Powell, that's his nickname for Jerome Powell. Too Late Powell is costing our country hundreds of billions of dollars. He is truly one of the dumbest and most destructive people in government, and the Fed board is complicit. Europe has had 10 cuts. We've had none. We should be 2.5 points lower and save billions on all Biden's short-term debt. We have low inflation. Too Late's an American disgrace. Too Late's is his nickname for Jerome Powell. But what are your thoughts on this tweet?
Well, I think neither the president nor Powell know what they're talking about. Monetary policy is not about interest rates. It's about changes in the money supply. So they're just looking at the wrong gauge. And of course, Trump's view on the gauge is he's a real estate guy. Have you ever seen a real estate guy who didn't want lower interest rates? No, is the answer. So that's how he's thinking. He doesn't. He's a business guy, a real estate guy who thinks he knows a lot more about the economy than he actually knows. So that's the end of that story. As far as Powell goes, he's totally off the reservation because he has, in testimony, actually rejected over and over again the quantity theory of money. Now, what that means in simple terms is he basically is saying that changes in the money supply do not affect economic activity, or they don't affect it in any reliable pattern or way. And this is just nonsense, utter nonsense. And the reason for that, of course, is that all the new macroeconomic models for the last 30 years have excluded money in the models. They're post-Keynesian models, and they don't include aggregate measures of the money supply and changes in money supply. So there's kind of a theoretical reason for that, and that's the model part of the thing. And actually, it's just common sense. I mean, If you go out and ask anyone in business or a worker and anybody, does the changes in the money supply affect economic activity? They would say, they would answer yes. And if you look, by the way, I've looked historically, just as an example of what I'm talking about. I've looked internationally and historically, and there's never been a significant inflation. And when I say significant, I mean over 4% a year that lasted more than 2 years, that was not preceded by a significant increase in the money supply. So if you increase the money supply, you're going to increase economic activity, and you're going to increase inflation. But that's out. That's out at the Fed. It's out at the Bank of England. Bank of England is the same. Bank of Canada, where you are, same. European central banks, the same. Some of the Asian banks, central banks, still pay attention to changes in the money supply, but they're kind of, in a way, outliers, shall we say.
Okay, thank you for watching. If you have questions or comments, leave them in the comment section below.